Hey, this is Mr. Bergman, and we're going to do the Work Together Problem 8-2. But before we get started, I do want to just review the types of accounts that we've been working with. So assets, if you remember, are from cash all the way down to prepaid insurance. Those are assets. Liability accounts are accounts payable accounts. And then we've been dealing with capital, which is known as equity account. If you remember, we transferred all of those balances from the trial balance side to the balance sheet. That's also the name of the financial report in which we prepared. One of the things about the balance sheet was we didn't include drawing. In fact, we only included capital. To figure out capital, we took capital and we would add any net income. I'm going to label net income as NI. And then we subtracted any drawing. And that gave us our new adjusted capital amount. That's going to come into play a little bit later. There's also sales, which is our revenue account, and all of these expense accounts right here. Okay? All of those we transferred over to the income statement columns. If you remember, income statement is also the name of the report that we put together, because revenue minus expenses equal income. Now, something that you have to realize is that all accounts are reports of what happened during a fiscal period. So for example, a lot of the fiscal periods we've been working with have been for 1 month. So the fiscal period, or the time that you're reporting stuff, may have started February 1st and ends the 28th. There are some accounts which on March 1st, we really don't care if it has a balance or not, because income has to match up with the time period that it occurred in. Same thing about expenses as well. So there are some accounts where the balance should be 0 on a new fiscal period. There are some accounts that should have an actual balance at the end of the fiscal period. So any accounts that should have a balance, like cash on March 1st, you'd want to have a balance. If it's August 1st or July 31st, you want to have a balance in cash. So anything from cash all the way down to capital, these are known as permanent accounts. Permanent accounts always have a balance. So it's very important. Okay? From drawing all the way down with expenses here, these are temporary accounts. And temporary accounts should, well, they should have a 0 balance at the beginning of the fiscal period. So you'll notice on the worksheet, these are the accounts that we're working with. Alright, so to start this off, we're going to go through and close these temporary accounts so that they can equal 0. Now, making that balance 0 is very important. And how you do that is very simple. The very first thing you start out with is anything with a credit balance, okay, that's a temporary account, you're going to make 0. So how do you make sales 5,511 0? Well, instead of crediting it, you debit it for the exact same amount. Okay, so let's do that right now. So let's go ahead and get started. So just like where we had adjusting entries right here, this is coming from a worksheet, so there's no source document. Instead, we have to label it because there's no source document. We'll label the 31st down. We'll put down sales. And we're going to debit sales for the amount that you see here of 5,511. So now we have a new account that we're working with here called income summary, and that's sort of like a recycling bin where you're just going to throw amounts in. It's just an account to help you close accounts. So we're going to, because we have to debit something, whenever we debit something we have to credit something, we're going to use income summary to serve as that temporary recycling bin that we'll just throw some stuff in and get rid of eventually. Alright, so we do that. The next step would be posting. So you would go through and you would post sales. You would put down the date, which would be the 31st. You would put down page 4 because that's where it came from, and then you would put down the debit entry of 5,511. Now the directions tell you type in a 0 for both the debit and credit columns. So we're going to do that to let everybody know that yes, this is closed, this is not a mistake, and then we're going to put down 410. All right, income summary, same deal. We're going to go to income summary. And we're going to put down the date, which is July 31st, and then we'll put page 4. Because it's a credit entry right up here, we're going to credit 5,511 right down there. And then because there's no balance, automatically by default it will have a balance of 5,511. All right, so then we'll put down the account number 330. All right, next step. Okay, after we've done sales. Okay, so anything with a credit balance. Okay, we do that first. The second step is we close anything with a debit balance. Okay, that's in the income statement side, aka expenses. So anything that has a debit balance, we're not including drawing. So we're going to go ahead and put all these expenses down. So I'm going to go. To close these out, I have to credit all of my expenses. Now, when I'm going through and I do that, I have to debit something. So once again, we're going to use income summary as a way to sort of, well, keep everything temporarily out of our hair. We don't know what the balance is at this point, so I'm just going to skip that, and we'll do advertising expense. Okay, we'll put down, let's see, insurance expense. We'll put down miscellaneous expense, and we'll put down the last one right here, which is supplies expense. Now you're going to get all of the balances and everything. Whoops. We're going to get all the balances down from here. Okay, so we're just going to record all these balances, so I'll put them in. So because expenses have normal debit balances, to make them 0, we want to go ahead and credit them. So advertising expense is 821. Insurance expense is 300, miscellaneous expense is 347, and you have your last one, supplies expense, 713. Now you could add all of these up to put your debit entry here, or you could take a look at your worksheet, and when all of these are added up on the worksheet, it equals 2,181. So we're going to put down 2,181. Okay, so then once again, we're going to go through and we're going to post everything. So we'll put down the 31st, we'll put down page 4, and this time we're going to debit 2,181. Now, without doing any math, I know that you could subtract these because opposites subtract. However, if you look on your worksheet, the net income, this 3,330, will be the same as the balance of income summary. So we'll put down 3,330. Alright, so then I put down 330 here, and then I go through and I close all of my expenses. So I'd have to go to advertising expense. When I go to advertising expense, I'll put down the 31st, I'll put down page 4, I'll credit 821, and then obviously I'd put 0 and I'd put 0. Alright, so for you to go through and finish this, you'd obviously need to put 510. I'm not going to go through how to do insurance expense, miscellaneous expense, or supplies expense, but just realize that you would need to close these accounts. I'm just going to go ahead and put these down like I've posted, even though I have not posted in the ledger, so you would need to post here in the ledger. Alright, last thing that we're going to do, or two things left, is this. We've already taken care of sales, we've already taken care of expenses. Now if you remember the definition of income, revenue, that's the first step, minus expenses, that's the second step, equals income. The third step will be we have to close income summary. So in order to close income summary, we need to take a look at the balance at income summary. Okay, and I have a credit balance of 3,330. So we're going to debit income summary for 3,330. So I'll put down income summary, all right, and I'm going to put down 3,330. Okay, now if you also remember, we need to credit something. Now net income, if you remember, net income right here, this amount right here was also credited, okay, eventually into the capital account. Okay, so net income has a direct impact on capital. So that is why we're going to put Darlene Wong capital. Okay, so we'll put Darlene Wong capital 3,330. Okay, so we'll go through and we'll close this. So we'll put that down. We'll put page number 4 down. We'll debit 3,330. We'll make this 0 and make this 0 right here. Okay, and then we'll put down 330 right there. All right, we go to capital. So we'll go to Darlene Wong Capital. We put down the 31st. Okay, we put down page 4. And what we'll do here is we'll credit it for 3,330. Now, if you remember, when we were figuring out capital manually, we would add in net income. Well, that's kind of the same thing that we're doing right here, is we're adding these two numbers in. So let me use my calculator, okay, to put down 6,543 plus 3,330, and you're going to get 9,873. All right, so there we go. All right, last thing that we do is we've taken care of sales first, expenses second, income summary third. Last one is drawing. Okay, if you remember when we were figuring out our capital amount manually, we would subtract drawing out. Well, the equivalent of doing that is to debit capital. Okay, now why do we debit capital? Well, it's very, very simple. If you look at Darlene Wong drawing, okay, Darlene Wong drawing has a debit balance of 2,100. To make it 0, we got to credit it. Okay, so drawing means you're taking stuff out of the business. Therefore, that means the owner has less capital. So we're going to debit capital for 2,100, and we're going to credit drawing, okay, to make it 0 for 2,100. Okay, so when we go through and we post, and I forgot to write the actual account number up here, so make sure you do that. When I post, put down 31, put down page 4, and I will debit 2,100. Okay, when I do that, and I just subtract this for 2,100, okay, I should get 7,773. Okay, and then I would post that 310. I would also need to post drawing, so make sure that you go here, you go to drawing, and you would post that amount to make it 0. I'm not going to go over that, but here's the key thing. This number right here is the same number for capital that we have on our balance sheet. So very, very, very important for you to recognize that. So that's how you do the income closing accounts. Once again, step 1 is sales. Step 2 is all your expense accounts. Step 3 is income summary. Step 4 is drawing. All right, these and shaded right here are all called temporary accounts, meaning they have to have a 0 balance at the beginning of the fiscal period. The accounts that are not shaded are called permanent accounts, and they are accounts that will always have a balance. It doesn't matter.